Short selling can lose more than a stock buyer puts in. The borrowed share obligation makes that risk different. Stay for the one question that matters before anyone treats a dramatic short interest number like a trading signal. Who has the power to change the terms or close the position?
K here. The shortcut story is sell high, buy low. The missing clause is that you sell shares you borrowed and you still owe equivalent shares back.
The order matters. First, the broker finds shares to lend. Then the short sale happens. Only later can the position be closed by buying equivalent shares and returning them.
The Securities and Exchange Commission describes that same chain in its Regulation SHO guide: borrow, sell, buy back, return. The sale proceeds aren't a completed gain. The obligation remains open until equivalent shares are returned.
A clean hypothetical makes the direction visible. Borrow one share at $60, sell it, then buy one equivalent share at $40. Before costs, the difference is $20. If the repurchase price is $80, the difference runs the other way. The point isn't that every movement is equally likely. A drop from 60 to 40 creates a $20 difference per borrowed share before the account's other costs. A rise from 60 to 80 creates a $20 loss per borrowed share before those costs. A rise from 60 to 140 creates an $80 loss per borrowed share. The price doesn't need to become imaginary for the loss to exceed the sale proceeds. That is why a person can't treat the $60 received at the opening sale as spare cash or as a completed return. It is tied to an obligation whose replacement cost changes while the position remains open.
Use this as a mechanism, not a recommendation. The numbers are hypothetical. What matters is that the repurchase price is unknown when the borrowed shares are sold.
And the clock doesn't end at the sale. Until the buyback and return are complete, price movement, borrowing terms, and account requirements can all matter.
Hold on, if a long buyer starts with $100, the loss stops when the shares reach zero. The short seller starts with a share obligation. That's a different denominator.
Nora, the Securities and Exchange Commission makes the core distinction clear. A long stock position can reach zero, while a borrowed share obligation can keep becoming more expensive. That's risk shape, not a prediction about any company.
That phrase, risk shape, is the useful callback. This is step 3 of the investment map. Map the risk. Before deciding whether an idea sounds convincing, identify what can rise, what can be demanded, and who controls the timetable. This is also why the phrase unlimited needs plain English care. It doesn't predict that every stock rises forever, or that every short position loses indefinitely. It names the absence of a mathematical maximum on a stock price. The loss side has no built-in zero floor comparable to a buyer's share price. A useful risk review asks what event would make the position painful before asking what event would make it profitable. That order is less exciting, but it's how an obligation becomes visible before a person takes one on.
No slogan fixes that. A ceiling isn't hiding somewhere above the screen waiting for the price to behave.
A calendar with no ending date is my least favorite calendar. The comparison isn't about courage. It's about whether the person can name the obligation, the loss path, and the party whose terms govern the account. A price opinion alone doesn't answer any of those questions.
Which missing term would you check before treating a short interest screenshot as a signal?
The joke lands because the open obligation is real. Next, we separate a borrow, a fee, and short interest data from the much louder story people often attach to them. Before we get to margin calls, keep one unresolved point in view. A correct price opinion doesn't remove the borrowing and account terms wrapped around a short position. Quick, honest ask while we are here. If this has been worth your time so far, hit like, then subscribe and ring the bell. I know everyone asks, but this one is free, and it is how a small channel like this actually grows. Professor Havel, start with the word that gets flattened most often: borrow.
Borrow means a broker has identified shares that can be lent for delivery. It doesn't mean the price will fall, and it doesn't make the obligation harmless after the sale.
Good. So availability is an operational input, not a directional forecast.
And it sits inside a margin account. FINRA says a margin account is needed for shorting because the broker lends the stock and the account provides the collateral framework.
That framework gives the broker a central role. The broker's agreement, its current house requirements, and its lending terms are part of the position. A social post can't replace those documents.
Costs belong in the Model 2. The Securities and Exchange Commission notes that the broker charges interest on the loan. If borrowed stock pays a dividend, the short seller must pay that dividend to the lender. That distinction changes the way to read a fee screen. A charge may be quoted annually, accrue daily, vary by security, or change with availability and the firm's policies. This episode isn't giving a rate because rates and account terms aren't fixed facts for every broker or stock. The useful education is to find the current disclosure for the actual account, then ask how the charge is calculated, how often it's collected, and whether a corporate action can create another payment obligation. A viewer should also separate a broker's margin loan interest from any securities borrow charge instead of assuming that every cost.
That makes time expensive even when the price goes nowhere.
Right, price is one clock. Borrow charges and a dividend date are other clocks. A person who only planned the entry date has not planned the position.
Short interest is another term worth putting back in its box. FINRA defines it as a snapshot of open short positions on brokerage books and records for a particular settlement date. It is a data point with a reporting date, not a verdict. The reporting label matters too. FINRA says its short interest data is collected for listed and over-the-counter stocks and is reported by firms around the middle and end of the month. That tells a viewer what the number describes, reported open positions at a point in the reporting cycle. It doesn't reveal every investor's reason, entry price, ability to hold, lending arrangement, or risk limit. Without those missing facts, turning the figure into certainty adds more story than evidence.
If the data arrive twice a month, it can't be a live scoreboard. That is a lag, not a prophecy.
And investors should avoid treating a single reported percentage as a squeeze forecast. Liquidity, new buyers, covering activity, and the broker's own terms can all alter what happens next.
The sequence is more important than the headline. A rising price can increase losses. That can prompt buying to close positions. Those purchases can add demand. But the loop is a possible mechanism, not a promise that a squeeze will occur.
K, this is the line we keep. Mechanism, not prophecy. Regulation SHU also requires broker-dealers to locate a source of borrowable stock before most equity short sales and imposes closeout requirements around delivery failures. Regulation governs settlement and market conduct. It doesn't make a position suitable.
Hold on, if the rule says locate, why can a broker ever close someone out?
Wait, those are separate controls. A locate addresses delivery at the outset. Margin maintenance and a broker relationship continue after that. One rule doesn't turn into a personal plan by being repeated loudly.
Keep that distinction for the final scene. We will not tell anyone whether to short. We will show the documents and questions that distinguish a vivid internet thesis from an understood account obligation. Professor Havel, thank you for keeping the operational terms separate from the headline. That separation is the viewer's first defense against mistaking market chatter for a complete explanation.
The failure trace starts with a stock price moving up quickly. The assumption that breaks first isn't necessarily the opinion about the company. It is often the assumption that the account can wait.
Then the margin requirement matters. FINRA says a margin call can arise when account value decreases or when a broker raises house maintenance requirements. Those are different paths to the same urgent question: what must be covered and when?
The second's investor guidance is blunt about margin risk. A firm may sell securities in a margin account without consulting the customer, and agreements explain what notice, if any, the firm must give. Read the agreement before an emergency makes it a scavenger hunt. The phrase "without consulting you" isn't a claim that every firm will act the same way in every circumstance. It is a warning to read the agreement's exact notice and liquidation language rather than relying on an app notification, a friend, or an old screenshot. Firms can have their own house requirements above minimum regulatory thresholds, and FINRA notes that a firm can raise those requirements. That means an account's relevant rules are both written and current. A broker is the right place to ask what its agreement permits and how its present requirements operate. The answer should be preserved in the actual documents, not reconstructed from memory after stress starts. For this topic, the record is more useful than a countdown fantasy: the written agreement, current requirements, and the broker's own explanation of its process.
I wanted a countdown timer. The agreement may not give one.
Exactly. Do not build a plan around an assumed grace period. First read the margin agreement, then find current house requirements. Only after that can someone ask their broker what happens if equity falls or terms change.
Nora, the agreement is the first handoff. A broker can explain its account terms and approval process. A licensed financial advisor can discuss whether a strategy fits the person's broader circumstances. A tax professional can explain tax consequences for particular facts. Those are separate questions, and combining them in a chat thread is how details get lost, because each professional has a bounded job. Ask the broker, which agreement applies? How does this firm calculate requirements? What can cause a deficiency, and where are the current disclosures? Ask an advisor, what does this strategy add to the person's goals, liquidity needs, concentration, and tolerance for loss? Ask a tax professional, what records or consequences should be considered for the person's particular facts? None of those questions asks a video to select a position. They turn vague confidence into a documented conversation.
One browser tab per question. That is still fewer tabs than Nora's road trip binder.
The binder has an index. Your point does not.
The CISSP Investment Advisor public disclosure page begins with a warning that prompts the visitor to acknowledge it before searching. Use the acknowledgement, then search the person or firm in the appropriate official record. The CISSP explains that the search can lead to FINRA broker check for brokers or brokerage firms. A registration record is a starting point, not an endorsement and not a substitute for reading the firm's own margin agreement.
Now test the claim that started the whole chain. If somebody says a high short interest number makes an outcome inevitable, ask for the reporting date, the source, the borrow terms, the account rules, and the missing downside. If those answers are absent, the claim isn't complete enough to act on. Notice how this reverses the usual social media order. Instead of starting with a chart, adding a confident narrator, and calling the missing details bullish or bearish, start with the claim's operating requirements. Is the data current? Is it a snapshot or a live condition? What is borrowed? What can the broker change? What costs or dividend obligations exist? What happens if the price moves against the position? A claim that can't survive those questions may still be entertaining. It has not earned the authority to become someone else's decision.
That is the transfer test. Replace certainty with a record. 5 fields, 0 predictions.
And don't confuse this education with an instruction to open, close, or avoid a position. It is a way to recognize that a short sale combines a market view with borrowing, margin, and a contractual obligation. The direction can look simple. The risk architecture is not. A useful review also writes down what would change the conclusion: a different account agreement, a different margin requirement, a different borrowing charge, or a different personal need for cash. That is how a viewer keeps an explanation conditional instead of turning it into a command.
Pause at the agreement, not the headline. That is where the obligation has a timetable.
If this clarified the mechanics, like the video and subscribe to Investing Explained. Send it to the friend who treats a short interest screenshot as the whole analysis. The missing terms are often the risk. The last question: which document would you read before trusting a short-selling claim? Borrowed shares make borrowed certainty expensive. Read the terms, then decide what help you need. Take care.